This episode is brought to you by Merrill. Join one of the most iconic names in wealth management, Merrill. You'll be part of a dynamic team of advisors and specialists working hard every day to grow their clients' wealth. And with the support of best-in-class research, advanced digital tools, and the resources of a global institution, it's truly an opportunity you can be bullish about. Learn more at careers.bankofamerica.com. Copyright 2024, Bank of America Corporation.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See detail.
Hey gang, today we're going to talk about the maturity of a trader and kind of the phases in which they go through and grow and develop as their account grows, hopefully, and kind of their priorities shift. There's kind of a lot to unpack in here. The initial conversation started with trade frequency and trading more versus trading less, and then why that happens. Why does one trader go from one extreme to the other, and blah, 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 blah. Anyway, we're going to hop into the podcast and let you hear all about it. But before we get started, do me a favor, hit that like button, leave me a rating and a review if you haven't done so already. You can do it while you're listening to the podcast. You can kill two birds with one stone, but it's the best way you can support the show, along with sharing this with your trading community. All right, let's hop in. Where are my pattern traders? There we go. Yes. Pattern traders, activate. It made me think of something. I was having a conversation about this the other day with a trader about frequency, and there was a trader that is here on the platform that was asking about frequency, and they're trading a strategy where there was one pair and they only got one opportunity a year. And we were having a discussion on like whether that is worth it, and for me it's not worth it. I don't know how you guys feel about that. One trading opportunity per pair per year is just a little bit too low. And kind of it brought up the question of like, well, is it a good strategy? And yes, if you get one trade per pair per year and it's profitable, technically it's a good strategy. It's a profitable strategy, but that is different from it being worth your time, right? Like it's you got to think about and I don't know how much time it takes for the trader to analyze the market. It's different if it's something that they can peek at, like a daily chore where they can peek at the chart for like 1 second and do it. But if you have to do like analysis every day and you're spending a half an hour going through charts for 4 trading opportunities a year, like it not worth the time, in my opinion. It's no different from like going to work and measuring your salary versus the hours you have to put in, right? You guys may be happy with, a $30,000 salary is nothing for someone who is working 1,000 hours a week, right? But a $30,000 salary for someone working 2 hours a week is a different story. So you got to kind of make those comparisons as well. But it just had me thinking about as my mind always goes off in these little different timelines and whatnot, about just trading in general, because on the other end, you have traders that do it too much. You have traders that want too much frequency. And I think many traders start off that way, where we think we have to trade all of the time. And you have to get hundreds and hundreds and hundreds of trades. And it reminded me of my journey of how I went from one extreme, not to the other, but I went from the extreme of like, I need to trade 50 times a month, to the point where I'm at now, where I probably get about only 15 trades a month. And that seems normal to me, but then when you look at what some other people are doing, you're like, man, that really is kind of a low frequency of trade. But it's boring, it's consistent, and if you're taking quality trades, it turns out profit. So it's more about shifting to quality over quantity, and once you kind of believe in that, and you believe in that by your numbers, that urge to kind of trade quote unquote more kind of goes out the window. But it's an interesting journey, because if you would have spoken to me when I first started trading and said, Akil, you're going to trade 15 times a month, I would have been like, you mean like a week, right? Like 15 times every 2 weeks, like, it just seems like such a small number. But you kind of have to grow and believe and be comfortable. I mean, everyone's personality is different too. Be comfortable with that. But the euro yen trade reminded me of that again this morning because again, it's patterns for me are kind of boring and monotonous because it's not. I don't want to say there's no analysis in it. There is analysis, right? You got to identify the X to A, blah blah blah. But I've been doing it for so long that it's second nature. So it's kind of like you see one, you measure it, you put an order on, and then like, oh, I'm filled at night, and oh, it came down and hit targets, and it's like no big deal. But you appreciate that that's how trading should be. It shouldn't be super exciting and heart thumping and crazy. It should be you did your job and you were rewarded for your job, and now you move on to your next job with a little bit more money in your pocket, at least for this time. Sometimes it takes money from your pocket as well, but it was a cool reminder of that. Igor says, I think the higher your bankroll, the less trades you need to take. No. See, that's the opposite. Well, I wouldn't say the opposite, but not necessarily the correct way of thinking. And that's another kind of now from a let's dig into that a little bit. So now I'll combine risk with that as well. Here's what I typically hear with newer traders, right? I typically hear that when I have let me know how this sounds to you guys. When my account size is smaller, I should risk more than when my account size is bigger, right? Now, in general, in many investment avenues, that is true, right? How many of you guys have ever been to like a financial advisor? Do you have like investments with a financial advisor or anything like that? Anyone? If you've ever gone to a financial advisor and they give you advice on investments, right? What is if you did it when you're younger, they will typically tell you, and they typically tell you a lot of things. So they think you don't know anything about investing, and they say all this fancy stuff to get over on you. It's. I love going to mine, and then or the first time I went to mine, and pretty much letting them know that I understand the industry, and I'm like, hey, we can avoid all this fluff. Just show me I just don't want to do this by myself, or I don't this asset at least. But anyway, when you're younger, do they tell you typically to be more risky or conservative with your investments? Right, when you're younger. When they're younger, you can afford to be more risky, right? Because you have more time. And again, with investments, you're thinking of the long-term game. You're thinking of growing this investment account for 30, 40, 50, 60 years, right? So you can be risky now because you have time to kind of make big gains. You're going to have to absorb some crashes, but you're going to have plenty of time to make bigger gains after those crashes as well. Now, if you're older, closer to the line of, then they typically tell you to be more conservative because you don't have the lifetime to absorb these massive losses and then make it up again, right? So the concept of when you're younger, when you're newer, risk more. When you're older, risk less is the same concept as when I have a little bit of money, risk more. When I have a lot of money, risk less. Because when I have a little bit of money, the idea is that I can afford to lose it and make it back up. When I have a bit of money, the idea is that, I don't want to risk it because I've already gained what I wanted to gain. And again, that's true to a certain extent, but in trading, if we're super risky with our initial account and we blow it, many of you are just done. There's no making it up, right? This isn't a job. This isn't a salary that you get where you can invest more, where a certain amount comes out of your check and goes into it. For some of you guys, you've saved up for so long to have this initial account, and this is it. If you blow it, you can't afford to save up another 10K to start over again. Or if you do, it's going to take you years and years and years. So we don't necessarily want to be super risky. And this is different than what Igor said about just risk averse in general. But I'm talking about the traders that are coming in with $5,000. They work so hard to save up this money, and their idea is I'm gonna be super risky and grow this as fast as I can. And what typically happens is instead of growing it as fast as they can, they blow it as fast as they can, right? And in attempting to grow it as fast as they can, they do a few things. They overtrade. They try to take more trades because the more trades they take, the more money they can make. in their mind, right? Time versus money type of deal. Or they do it with higher risk, where it's like 1% risk. You're crazy. Let's risk 5, right? The same conversation we had yesterday about, I guess you guys didn't hear. I did a podcast after our conversation about trading to win versus trading not to lose. But the idea of like, I'm going to risk more instead of thinking about the downside of it, like, well, I can blow this account quicker. But having that locked in mentality that, oh, if I risk more, there's just more reward on the other side. So I don't think it necessarily has much to do with your bankroll. The higher your bankroll gets, I think it has more to do with the maturity of a trader, right? Again, I can almost guarantee when all of us come into trading, we just want to trade, right? We see so many things and so many techniques and strategies. This world is so new. It's imagine being teleported to a brand new world, and it's nice and green. There's no pollution. There's trees that sprout. There's bananas and apples and all the greatest things in life, and you just want to do it all. The rivers are I was gonna say Kool-Aid, but that's probably bad for our system. The rivers are flowing with your favorite drink, and it's all clean. You can just do whatever you want. This is your dream world. And you just go crazy because you want everything, and you're going everywhere, and you're running everywhere, and you tire yourself out. As you develop as a trader, that stuff becomes more normal, and you start to kind of realize the stuff that actually matters, and it's just not, it's like a car, right? It's not new and exciting no more. It's kind of just normal, regular, boring, and you find yourself settling into, instead of running around trying to eat everything in this magical land, you're only focused on the best things that you want. And I think that's how we naturally go from one to the other. The other thing as well is that, and we me and Jason both spoke about this, the natural shift from action to freedom, right? So it's interesting because we typically get into trading because we want to make money. And many of us want to make money because we know it could buy us freedom of time, or freedom, freedom of money, but freedom of time as well. And there's a point when we realize that, man, if I'm investing 12 hours a day on a chart, am I really giving myself freedom of time? And the answer is no, right? So a lot of traders naturally shift from a lower time frame to begin with, where we want action, to a higher time frame where it gives us more freedom. And we understand that I can make the same type of profit on a 4-hour as I can on a 15. But the 4-hour requires less, I don't want to say less time. I didn't want to say energy or effort, because it takes a lot of effort. But the 4-hour requires less time than the 15-minute. So you're telling me I can invest less time and get the same return? That's a good deal, right? Would you guys take that? Would you, going back to the salary thing, if I promised you the same salary but to work less hours, why would you not take that? So I think that's the shift that we see as traders mature. They go to higher time frames. They focus more on quality of trade over quantity of trade. And automatically, when you do that, when you cut down on how much you're trading, when you eliminate all the dumb stuff, when you go to a higher time frame, which is naturally slower and has less frequency, you go from someone that's taking 50 trades a month to 25 trades a month. So you naturally see that kind of that slowdown in frequency. So it's interesting, and again, it's kind of cool because I went through the same thing myself. Hope you enjoyed. Before you leave, if you're brand new, make sure you take the 10 episode challenge. What that means is I want you to listen to 10 episodes of the Trading Coach podcast. You can pick 10 random ones. You can pick 10 purposeful ones. I don't really care. Just listen to 10 episodes before you pass judgment on the show. If you hate it, go somewhere else that gives you more value. If you love it, make sure you tune in 3 times a week on your favorite podcasting app. That way you don't miss the next episode. All right? Until next time, plan your trade, trade your plan. Take care.